Welcome to WorkSpan TV. I'm Ryan Johnson, joined today in the studio by Google's very own Frank Wagner and John Schirm, and we're talking about the evolution of Google's equity program. Now guys, last year you came and talked about the evolution of your total rewards offering, one of the most popular videos that we've ever published or produced here. So let's talk about equity a little bit. Let me start with you, Frank. You've changed your equity programs in the last few years. There's been an evolution. Maybe you can just touch on some of the phases that you went through in changing your employee equity program.
The phases that we went through really represent the phases of Google itself. There's a pre-IPO phase when we were a startup and we granted only stock options. Then the next 5 years post-IPO, from 2004 till about 2009, we actually implemented some very significant major programs. And it was in concert with a tremendous growth in our employee base. We were doubling in size every year in terms of number of employees and needing to attract lots of employees to come to Google. In our current phase, from 2009 onwards, we're still in a very much a growth mode. We're still adding lots and lots of people, but we're focusing more on the optimization of our equity programs as opposed to making major earth-shattering changes and moves.
Let's get into some of the specifics if we can, John. What were some of the features that you implemented in these changes to your equity program?
So the first feature that we added was our transferable stock option program. And that's a program so that employees would be able to get closer to the publicly traded value of options versus the strictly intrinsic value of options that most corporate options exhibit. After that, we looked into a couple other changes. We implemented a stock option exchange in 2008 that was around the same time as the broad market slide of 2008. After that, we tweaked our programs around the margin. We implemented our tiered vesting schedule so that employees would be able to get their equity faster in a more consistent method. And we also implemented our GSU auto sale program. GSUs are Google's version of restricted stock. And our auto sale program is like a 10b5-1 light plan where employees are able to sell their vested GSUs upon vest versus waiting for an open trading window.
So Frank, you learn any lessons along the way here? Anything you would do differently?
Well, sometimes we tried to over-engineer things a little bit, I think. First, one of the things we implemented in early phase 2 was the ability to adjust our restricted shares for employee performance with the belief that maybe we didn't give people the right size grant. So if they're in the tail of the distribution, either in the high end or low end, we could tweak it up or down appropriately. In addition, we also had an amount that, or an approach where we had an algorithm that if the stock price changed and folks got options at a certain price and their next cohort got at a much higher price, we could actually tweak the folks who miss out on that appreciation by adding and incrementing their stock units. A technically interesting solution, but really complicated, and it only affected a small fraction of the employees. And then we actually had to explain it to every new hire why their equity that vested was actually going to go up or down at the time of vest. So in retrospect, maybe we were getting a little too detailed and too googly.
John, what else would you have done?
I think we've had a really big benefit to all the automation that we've done for our stock systems. And I would have done that automation earlier, given the return on investment and the benefit that we've had from that.
John, I know you obtained a lot of employee perspective when you were making these changes. Maybe you can just share about that a minute.
So we go to our employees a lot. Googlers are notorious for having a lot of feedback, and we love listening to them. Some of our greatest ideas have come out of that. We've gone in 3 different ways to them. The first is through a conjoint study, and we talked about that last year in our previous WorldatWork conversation. And a conjoint study basically looks at preferences. So we go out and ask employees, how would you trade base for bonus, base for equity, within equity, base for GSUs, or for options? And when you ask that question multiple times, you get a true answer of how much an employee values their base salary, their bonus, their restricted stock or GSUs at Google, or their options. The second ways are more through our employee engagement surveys. Every year we go to our employees and we ask them on a scale of 1 to 5 how happy they are with various elements, from compensation to workplace satisfaction. We take that data, which is confidential, and we're able to get a lot of good trends out of that and look at the specific programs that we want to focus on, whether that's changes to salary, changes to how we benchmark, or changes to our equity programs. The third way we've gotten employee feedback is through just going out and actually talking to employees face to face. We'll do a lot of focus groups whenever we're maybe thinking about changing something or just for good practice so that we know that we're staying up to date on the anecdotal feedback from Googlers. When we did that for our equity programs, we met with all of our employees, a representative sample of all of our employees. So we would stay at work late, meet with the APAC population, Googlers in India, made sure to bifurcate it by function. So we had the opinion of sales Googlers and of technical Googlers.
So you're Google, obviously, you guys are very different. Is there any lessons that can be applied from Google potentially to other companies through this most recent process that you went through?
It really does make a difference in our willingness to go think outside the box, and we had leaders who were asking great questions. But really, most companies, if you can get executive buy-in to whatever you're suggesting, and you have the resources to be able to allocate to implement, you can do a lot of these changes. Maybe it's harder to do major changes like a TSO program or a stock option exchange because you need shareholder approval, and for example. But for the optimization aspects, a better communication, changing vesting, the auto sale, those are features that any company could probably implement.
Well, I want to thank John Schirm and Frank Wagner from Google for coming in and talk about the evolution of Google's equity program. For WorkSpan TV and World at Work, I'm Ryan Johnson.